Hi, everyone. Welcome to another episode of Bits and Bips, the interview, the show where crypto and macro collide one basis point at a time. My name is Steve Ehrlich, head of research at SharpLink, and also your host. We've got a terrific episode for you today, but before we begin, let's take a brief moment to hear from some of the sponsors who make this show possible.
Multi-Chain Advisors is an emerging technology growth firm that has helped create $50 billion in enterprise value for 80 plus clients over the past 4 years. They're the partner to help navigate markets. Build real traction today at multichainadv.com. Quick note before we get into today's episode. Bits and Bips now has its dedicated feed. We're spinning off from the Unchained feed and moving to a new podcast and YouTube channel. So if you want to keep up with our weekly live streams and macro meets, crypto breakdowns, make sure to subscribe to Bits and Bips directly. We won't publish there until March, but subscribe today so you can be ready for launch. Be sure to subscribe to the new feeds at unchainedcrypto.com/bitsandbips.
All right, welcome back. So my guest today is Laurens Fruassen. He is a research analyst at Kaiko, and we're going to discuss everything from markets collapsing across all asset classes in light of the surge in energy pricing, as well as some news that has popped up over the last couple of days that actually should be bullish for crypto, namely the launch of Tempo's mainnet and sort of the agentic commerce wars that are coming. And we're also going to touch on tokenization, NASDAQ getting its long-awaited clearance from the SEC to begin offering tokenized versions of stocks alongside its traditional order book. So much to discuss. But before we begin, and I introduce my guest, just as always, everything that you hear on the show, none of it is financial or investment advice. Please see unchainedcrypto.com/bits and bips for full disclosures. And with that, welcome, Laurens.
Thank you, Stephen. Thanks for having me on the show. Happy to be here.
Yeah, thrilled to have you as well. So let's really dive right in. As I was preparing the show a few hours ago, I was sort of debating whether or not to characterize Bitcoin as sort of remaining as a safe haven amidst this geopolitical crisis in Iran. It dropped yesterday along with most other assets in light of the Fed holding rates steady and sort of cautious commentary from Fed Chairman Jerome Powell about the impact of persistent or the potential for persistent inflation because of everything happening in the Gulf. As we are recording now, I believe Bitcoin has dropped under 69,000, even though it is still beating metals and some of the other assets that are doing even worse. But let's just start right there. I mean, what are you seeing, and kind of like how are you monitoring all of this on Kaiko's platform?
In terms of how we're monitoring Bitcoin, we usually look at liquidity and how that's changed over the past couple of months. And what we can see is that since the 10th of October, which was obviously a huge hit for the market, liquidity has dropped from 25 million on average at 1% from the mid price to 15 million on average. And because of that, we also see that there's a lot more volatile moves happening in the past few months. Like we saw this short squeeze rally from 60K to 72, 74-ish K in the past 2-3 weeks. On top of that, we've seen 30%, 40% in reduced volumes. And this, of course, has a lot of impact on how investors are approaching crypto right now. Is it a safe haven asset or not? We can discuss that later as well. Currently, I would say that BTC has been outperforming gold purely because gold has had a very aggressive rally earlier in the year, whereas now it's leveling out a bit, comparatively speaking. And yeah, I would say that in terms of infrastructure, there's a lot of good things happening in the crypto sphere. You have the CFTC and the SEC finally giving clarity as to how majors should be presented. They're not securities anymore. Some of them are commodities, and that's all very good in terms of how institutions should approach crypto.
Okay, yeah, a lot to kind of unpack there. So let's kind of get to it piece by piece. I want to go deeper into what you're saying in terms of Bitcoin and sort of, I guess it's a relative buoyancy compared to other traditional safe havens, at least over the last week or two. It briefly touched on 76,000 just a few days ago. It's obviously down since then. on my show last week, we had Andy Bear from GSR, and he sort of mentioned what you just discussed too, that sort of the competing narratives as to whether or not Bitcoin's functioning as a safe haven because people now see it as a safe haven, or is it just sort of a reversion to the mean from gold just surging over the last year and a half, and Bitcoin being punished along with tech stocks that had been hammered over the last few weeks because of AI fears. And again, maybe it was just things sorting themselves out. I'd love for you to just go a little deeper and sort of explain, like, how did you see the last few weeks? And then how does that play into what we're seeing right now, where Bitcoin is sort of teetering, it's straddling the $70,000 line. I'm seeing some analysts predicting a drop back down to 65,000, perhaps further, especially if energy prices remain higher for longer. So maybe please just provide a little more context.
Yeah. So what we also saw in the past few weeks is that when we bottomed early February, we saw open interest finally stabilizing in the perps market, and because of that, a lot of forced selling finally stopped that bleeding that we previously saw. And because a lot of shorts also jumped into that or started betting on a breakdown in that 60K region, we saw funding rates going negative slightly and immediately saw whiplash back upwards, namely after the first part of the, let's say, the geopolitical conflict in Iran was concluded, alongside with oil prices rising and switching a lot around comparative to BTC. And what we could also see is that due to institutional flows kind of stabilizing us around that 60K region, with ETF flows finally flipping positive after, I believe, 3 months of negative outflows, that has helped us stabilize in this 60 to 70K region. And whether or not this is the bottom, liquidity metrics would say we still need to reaccumulate and slow down a little bit and make sure that things are settled properly before shouting, oh, we're going back to 100K, right? And that's going to need time to rebuild that investor confidence. Like I mentioned earlier, if you look at market depth, it's down 40 to 50%, volumes are down 30%, and that all needs to increase in order for us to say, like, oh, hey, actually, Bitcoin is a safe haven asset. We can use it as an inflation hedge, because right now it's more functioning as a high beta tech stock rather than a inflation hedge which you can buy to hedge inflation. And what we also see is that since yesterday, after the Fed announcement, the S&P finally started moving a little bit, which obviously is because of growth fears and inflation fears. And BTC, as a result of that, BTC also sold off a little bit after seeing a brief deviation above 72 to 74K.
Okay. I'm curious. I mean, you track retail and institutional flows, but are there any notable differences or divergences in behavior geographically? Do you see more of a bit coming from Asia versus the U.S., or are there any ways, any particular like subsections of the crypto buying community that are worth pointing out?
Yeah, what we saw in the past 3 months is that Asia used to sell a lot in the past 6 months in general. And that has now shifted from Asia is actually buying in the past 3 months, with cumulative returns per session being up 0.2%. But compare that to the EU and the US session, which is down -11 to -12%. So we're seeing some buying from Asia finally after selling off a lot, whereas the US and EU are still selling consistently. However, important to note is that we are still very dependent on Coinbase flows. And whenever the Coinbase premium comes back, we do see an uptick in BTC price. And we do see that BTC moves more favorably to the upside, as opposed to when that Coinbase premium isn't present.
Okay, that is interesting. I mean, we've spoken about the Coinbase Premium before on the show, but for people that may not be familiar with it, I mean, can you just talk a little about like what are the ranges for the numbers and where is it right now and what kind of is where does that fit contextually in history?
Yeah, so usually when we speak about a Coinbase Premium, what we mean is that the price on Coinbase's spot exchange is higher than Binance or Bybit's spot exchange. That can range from $50 to $500. Currently, it's only a 0.2%, or it was only a 0.2% increase, I believe, from Binance's spot books. But we do notice that traders are actively looking at this premium to position themselves into the market, be it short or long, which is a very interesting thing to keep monitoring as well. And something I forgot to touch upon earlier as well in terms of liquidity. If we compare open interest 6 months ago, before the October 10th, we had 35 billion in open interest across the market, whereas now it's 15 billion, and that also needs to recover for us to signal, okay, hey, we're recovering here, things are looking up again. Maybe we're gonna break market structure here and move back to the upside above 72 to 74K, and we can take it from there.
Okay. And what about longer dated derivatives, long-term derivatives, just to kind of span out to the further out into the year? How are traders positioning themselves? Especially, I don't know if there's been any interesting or recent movement because of how volatile energy markets have been, in particular over the last 12 to 24 hours.
There's a 2 billion options expiry tomorrow, which isn't long dated, of course, but that's something that needs monitoring here, because it's a big options expiry in the sense that max pain is at 70K and currently we're at 69K, which means everyone's losing money based on theta decay, right? But looking at longer dated options, we can see a lot of people are still betting on BTC going to 100K over the next 6 months. Especially the December options expiry is a very interesting one to watch, which is usually heavily traded months in advance, as well as puts heavily betting on us going to 40 to 50K, something we're also seeing in prediction markets, even though those markets are a lot smaller, right? So it's either 50K or 100K in terms of the price that we currently are and where we could go. It's more focused on short dated options across the market.
And I know crypto markets in general tend to be highly correlated, especially during acute periods of market stress. But are you seeing any interesting behaviors for assets beyond Bitcoin, ETH, Solana, XRP, or even I know Hyperliquid Hype token has obviously been doing well because of so much activity on that platform. But are there any other assets that are worth kind of calling out that are either doing particularly well or have been struggling in light of everything going on?
Like you mentioned already, Hyperliquid, of course, which has seen tremendous increase in terms of volumes, mainly due to equity perps launching on their HIP3 block, right? Other than that, I feel like the overall crypto market is struggling pretty heavily, and everything is super correlated. People are focusing more and more on stablecoin chains. You have Paradigm and Tempo launching stuff, Argus launching their Circle is launching their ARC blockchain, right? And in that layer, you also have Plasma, which is super interesting. But I feel like layer one blockchains are kind of moving away from this traditional way of building a chain, and they're now more focusing, okay, we're gonna build an app-centric chain, in the sense that we're gonna build a chain that only does stablecoin payments, or we're gonna do a chain that only does DeFi. And that's an interesting development as opposed to how crypto was approached a couple of years ago, in the sense that it was super cypherpunk. We wanted to be decorrelated from the financial system, whereas now everything is converging, and we're trying to get on these traditional payment rails. We're trying to use stablecoins for real world payments. We're trying to launch US tokenized treasuries and getting guilds on chain and making sure we can use money market funds as collateral. So I would say that's another interesting development in the crypto market in last, let's say, 3 to 6 months, which is accelerating. And I think the infrastructure for that is being built right now, and we'll definitely see use of that in the future as well.
Mm-hmm. Yeah, and we're going to get a lot more into stablecoins and sort of the agentic payment wars, for lack of a better term, in just a few minutes. But I just want to tie the bow or tie the knot on the macro markets discussion that we're having here. As we're talking, it's been a big rate week. I mean, the U.S. held rates steady, ECB held rates steady, Bank of England held rates steady. I think the Australian Central Bank actually raised rates, but everyone is sort of changing expectations, factoring in or anticipating 0 cuts perhaps this year, even some rate hikes, just given how fears of persistent inflation because of energy and heightened energy prices is just really kind of causing a lot of fear and panic as this war, which I think is entering its 3rd week, is going on longer and longer and expanding geographically. Do you see anything else? Do you have any other big predictions? Are you? I know your platform, your company, you track how the smart money is moving, positioning. We're going to get into stable coins in a section and how people may or may not be moving into those. I know that a lot of traders, I think there was a Bank of America survey that pointed out that fund managers have moved into cash at the highest levels in quite a long time. Is there anything else that you're seeing related to the current market dynamics today and how they're positioning in the future that's worth mentioning?
Yeah, we've had all this positive news, right? Like we mentioned earlier with the CFTC and the SEC finally properly mentioning and stating what crypto assets actually are and how we should use them. And personally, I expected a lot more of a positive reaction from crypto side. Like a good trader once told me, or actually a trader I still speak to regularly, is that the reaction to the news is more important than the news itself. And as of right now, we haven't really reacted that positively. But to dive more into the macro aspect, what I also think is important to consider is that financial conditions matter a lot more than Fed rates, and financial conditions are driven by geopolitical issues or geopolitical clarity, or lack thereof, and which in turn is largely driven also by market performance. And what we can also see, or what we saw, is that financial conditions started tightening long before the Fed started hiking, and they started loosening long before this hiking cycle was getting into stride. So looking at CME options as well, odds of no cuts jumped to 33% from 5% in the past 48 hours, I believe. And yet the S&P is still only down, let's say, a mere 4 to 5%. It was 2% prior to yesterday's Fed meeting. And I think one of the reasons of extended hold raise is that the market price long-term inflation expectations, they seem to be stable, but despite expectations of oil prices rising and staying there for quite a while, I still think it's quite concerning how the US market is seemingly, or at least the indices, like the S&P, are still pretending, like the traders positioning into them are still pretending like nothing is happening. Like, for example, here in Europe, rate hikes are showing up in market expectations, like you already mentioned. And if this causes any issues in global stock markets, we'll probably also see any impact on US indices, as investors will just likely try to sell what they can. And banks don't really ease into oil shocks because it increases inflation and it decreases growth because spending goes down.
Yeah, I mean, a lot to discuss there. I mean, it's kind of curious that divergence between the U.S. and the EU that you mentioned. Because one of the things I'm watching too, and I'm sure you are as well, the U.S. is more self-sufficient when it comes to energy, whereas Europe is highly dependent on imported, like natural gas in particular. So it would make sense that at least like U.S.-based indices might be a little more resilient than in Europe. But I mean, also just like the nature of flows, like passive flows into some of these big ETFs and stuff. It's just not. Sometimes they're just not as reactionary as perhaps we may want. And you're sort of the idea that you mentioned about like credit conditions, liquidity tightening before we actually see the associated impact in indices. That's pretty curious too. I mean, it makes me think. Maybe things aren't entirely related, but it makes me think of just everything that's happening in private credit, especially in the U.S. I think the Bank of America actually just had to walk back a memo where they recommended the clients shorting, I think, 17 different stocks, European stocks that were exposed to private equity, private credit. I mean, and just kind of waiting for more dominoes to fall there. But I know whenever we start looking for conditions tightening, we look for defaults, et cetera, et cetera. So that is something. That was a good point that you brought up. All right, so we're going to turn the page to a few perhaps bullish catalysts for crypto. But before we do, let's just take another quick break so we can hear from some of the sponsors who make the show possible.
Multi-Chain Advisors is an emerging technology growth firm that has helped create over $50 billion in enterprise value for more than 80 clients, like Pith, MoonPay Commerce, and Wormhole. They've worked with some of the largest and most impactful companies in the space. They're the partner you want when you're navigating markets and trying to break out from the noise. They help navigate TGEs, go-to-market, BD, and partnerships, capital markets advisory, PR, media placements, KOL activations, and more, driving execution from launch to scale. Their results are measurable. To learn more and start building real traction today, visit multichainadv.com.
Quick note before we continue with today's episode. Bits and Bips now has its own dedicated home. We're spinning off from Unchained and launching a standalone podcast and YouTube channel focused on the Fed, macro, AI, and how it all collides with crypto. If you want to keep up with our weekly live streams and macro meets crypto breakdowns, make sure you're following Bits and Bips directly. We won't start publishing until March, but getting set up now means you'll be ready on day one. You can find the new Bits and Bips channels at unchainedcrypto.com/bitsandbips. You can also find us by searching Bits and Bips on YouTube, Apple Podcasts, Spotify, or wherever you listen.
All right, and we're back. So for years, I think really since ChatGPT exploded on the scene a couple of years ago, people have been trying to marry crypto and AI and talk about how they go together, the synergies, et cetera. But it looks like it's finally happening. Coinbase made a lot of waves, I think, last year, November, during one of their product demo days. And I don't even think this was one of the big products that they were launching, but with their X402 payment standard for agentic commerce. Tempo just went live with the mainnet with its own machine-to-machine payments protocol. And everyone is talking about agentic commerce and bots transacting with each other at the behest of humans for all sorts of reasons and use cases. So I'd like to just kind of throw it to you, kind of open-ended, Laurens. I mean, what are you seeing in terms of agentic commerce? Like, what are your expectations for how this sector can grow? And perhaps most importantly, with many different offerings now out there, what do you think is going to sort of delineate or demarcate the winners from the losers?
Great question. I would say that something very important to note here is that if agentic commerce is going to, let's say, revolutionize the way we're doing things, is that they need robust pricing and proper pricing mechanisms, because some of these agents they operate at their own peril, and if they start doing transactions that are worth $1 at 3 cents, you're going to lose a lot of money, or you're going to make a lot of money regardless of which counterparty you are. And in terms of how the market can grow, it's I think it goes hand in hand with how stablecoins are growing and how they are being used in terms of on-chain capabilities. And it's a $1 trillion market. There's multiple researches also done by McKinsey, I believe. There's probably more out there. We've seen Coinbase's X402 processing $34 million in volume. Google is launching a payments protocol. So everyone's trying to jump on the hype train, and it's going to be very interesting to see how that converges alongside stablecoins, because in 2025, we saw 33 trillion in stablecoin volume. That was all done by humans, or probably mostly done by humans. So it's very interesting to see how that is, or very interesting to observe how that's going to grow as we see more agentic payments launch, and how that's going to slot into TradFi, as well as crypto, as well as just e-commerce in general.
Yeah, it's one of the things that I'm trying to track, and I would imagine you might be as well, is really figuring out how to get a real sense of activity, like upticks in activity when it comes to these types of bots. Because like, if you create some basic bot on Claude or ChatGPT or whoever, I'm not a coder, so I'm not really able to go too deep into this. You might create like I'll make a task for something I'm doing in SharpLink, and it'll create 10 different bots for me doing 10 different things simultaneously, and then once it's done, it goes away. We'll look at something like network addresses. Like that's a common metric that we try to use to understand actual usage of a blockchain like Ethereum, Solana, Bitcoin, whatever. I could see like an exponential increase in new wallets, new addresses, but they're not persistent, and they don't go on forever. And when it comes to stable coins too, like you can make you could say, well, these new types of blockchains with micropayments through stable coins, a lot more payment volume, but the value may, like, unless there's going to be new use cases that were not priorly viable before agentic commerce, like you may not necessarily see a huge surge in volume. What are you like? How do you think about this problem? Like, what are some of the numbers or metrics that you think will be really helpful in sort of getting a sense of true adoption of agentic commerce?
I would say looking at unique addresses, looking at how these transactions are conducted, where they're going. Is it just like spam being conducted to inflate numbers, right? I saw a paper saying recently that the volumes on the unique addresses on USDT are a lot different compared to those on USDC. So that's all metrics we're looking at via blockchain monitoring, a solution we built to look on chain. But what I would also look at is how can we use these agents to actually, like you mentioned, do something that previously wasn't possible, right? Do we really need these agents right now? Is it actually useful for us to use them? Because I might just do it myself. I might just order whatever I want to order myself. If we're talking about trading, that becomes a whole other thing, right? Because you can start automating your system, you can start automating strategies, you can do a lot more things on chain, especially the way blockchain is interoperable with AI. So that opens two different pathways, in the sense that from let's say a retail perspective, is it useful for me to put an agent on this? Does that agent need to do transactions for me? And on the other hand, you would have to, let's say from a trader perspective, how can I automate this strategy? How can I make sure that agent isn't going to make any mistakes for me? And how can I make my life easier and more, let's say, put it on autopilot from that point of view?
Yeah, because the last thing you'd ever want is one of your agents like accidentally revealing a private key, or I was reading some things about like at some point the Nigerian prince scam is going to come for AI agents, and some benevolent agent is going to want to say, here, I'll help. Here's $500,000 of USDC, and what do you do then? So it is kind of fascinating. I do want to ask you a kind of a more, I guess, like foundational or theoretical question about this debate, because it is coming up now. I mean, we're seeing like Coinbase X402. I believe it's on Ethereum and Solana, but correct me if I'm wrong, where it enables payments. And it actually shipped a couple of big upgrades either yesterday or the day before to sort of make it so that almost any ERC20 token can be used in these types of payments, as opposed to, I think just before was USDC. But Stripe, Tempo, I mean, their protocol, it's very different. It's much more efficient, but it's sort of like batches transactions instead of like settling them on a gross level. And it raises the same debates, I think, that came up when Tempo was first created or ideated or sort of revealed to the world. That is it really a blockchain, or is it just a permission database? And we might be seeing this battle between the permission database and then the permissionless databases or permissionless blockchains like Ethereum, Solana, etc., going after these agentic payments. And it's not just an educational or like academic debate, because investors who are listening to this show, and again, this is not financial advice, but they're going to wonder, where should I put my tokens? Should we buy into these protocols, or actually, I'm actually forgetting if Stripe is private or not. I think Stripe may have been purchased by Visa, but I'll have to double check on that. But how should they think about allocating assets to in light of like this big divide in different agentic payment offerings?
I think it very much depends as to what you want to use your assets for. As you mentioned, ETH's permissionless. Some of these other blockchains may pose as permissionless, but actually they're fully centralized. That's a completely different debate, of course. And I think it also will depend as to how well the infrastructure of said blockchains is integrated into the financial system or into Visa or into MasterCard, right? You don't want, like, I think the average retail user doesn't really care which tech stack is underneath it. They just want it to work. And I think Luca Netz mentioned it on one of your podcasts a couple of weeks ago as well. Like, I don't care if Instagram or Twitter is built with Python or any other coding language, right? I just want it to work, and I want to know, and I want to be able to use it in a very easy and understandable way. So I think the infrastructure layer is very important, and it needs to be robust. Pricing needs to be correct. All of these mechanisms need to be in place. But once I start using the app, or once I start doing payments, be it agentic payments or not, it needs to be seamless, and it needs to just work.
Yeah.
With a click of a button or two, right?
You
don't want to be entering a complex EVM address. And also to your point earlier with AI agents going rogue, right? Some of these AI agents, they've been susceptible to address poisoning. I'm not sure if you're familiar to the topic, but for those that aren't, address poisoning is when you get sent a token that ends in the same few letters that your address ends, but the things in the middle, so the address in the middle, is completely different. And some agents have been able to getting tricked by that. So that's another extra layer of security you would have to add into these agentic payment bots, let's say, before you can fully ship them and start using them.
Mm-hmm. Yeah, and those are all really, really good points. And I just want to, I don't know if correct, but update something I said before. So Stripe is a private company. It's a partner of Visa and the card networks, but it's a private company. So the choice isn't buying stock in Stripe or one of the other blockchains, but I guess maybe buy into Visa or some of the card networks that might utilize Tempo. But and the other point you mentioned too is kind of interesting as well. I mean, AIs are not going to necessarily, I guess, have the same type of brand loyalty or blockchain loyalty that humans will. Perhaps theoretically, you could tell your AI to prefer one over another, the same way that, like, I I have certain preferences for payment rails for different types of financial transactions that I agree in, but for the most part, they'll probably try to do it as cheaply as possible. So perhaps like they might try using Ethereum L2 one day, then they might use SWI another day, Solana, etc. So I guess whatever you tell them to optimize for, that's what it's going to be. So it's going to be really fascinating to kind of see how sort of the wars, or I guess the winners, the breakdown between the winners and losers when agentic commerce really becomes more mature than it is now. Okay, so we just have a couple of minutes left. I want to touch base on two other topics. One you mentioned, sort of the muted reaction to the market from sort of the interpretive guidance jointly issued by the CFTC and the SEC. I actually have a take on that I'd like to share with you, and maybe you could react to just have the discussion. I personally wasn't surprised at much of that the market kind of shrugged for two reasons. One, a lot of what was already in there, I think, has already either been common expectations, common knowledge, or has already been issued under prior guidance or through sort of the conclusion of various like legal entanglements, like lawsuits against the SEC for like whether or not like ETH is a security. The SEC had already issued guidance highlighting how, like, sort of updating what Gary Gensler put out, or the SEC under Gensler, that staking isn't necessarily a security. So a lot of those types of things were already kind of in the air supply. The same thing with NFTs. That NFTs, assuming that they're just NFTs or meme coins, are not securities, that also wasn't new. So I wasn't surprised by that. And then, I mean, as I'm sure you know, interpretive guidance is kind of the lowest level of sort of a statement that the SEC can make. It's not like a formal rule that went through kind of a process where they solicited feedback from the community. And while this was a positive step forward, and it was a nice signal that the SEC and CFTC are playing nice together, although they've been doing it for a year and a half or so at this point, everybody wants clarity. Everybody wants the law. And and I know, I think Senator Lummis said that, I believe she put out a statement yesterday or the day before highlighting or saying the clarity is going to pass out of committee by the end of April, which would be tremendously welcome news. But there's still two big issues that need to be worked out. One is the yield question, which really should have been handled under Genius, but that ship has sailed. And then two, I guess the question of whether or not President Trump, his family, close advisors are allowed to participate in crypto during this whole process. And those have been largely intractable issues. And as you know, rules and guidance, they can be reversed like that when there's a new, whenever someone new enters as SEC chair. So that's kind of my take. I'm curious if you have any reaction to that.
I was particularly surprised to the muted reaction because with the current administration, I feel like we've been in to coin it, a headline super cycle, right? The market has been very reactive to headlines. So in terms of that, I was quite surprised the market didn't really react to it. Maybe it was partially priced in already because we did move from 60K all the way up back to 72, 74K, right? Which could have been that preliminary positioning. So yeah, that would be my idea, my take on it. And to add on to your point of the Trump family being allowed to do what they're currently doing, I think we can all look at it and be like, yeah, that's not right. In a recent research report, what we did, we could see that Liberty Financial started selling off 6 to 12 hours before the 10th of October crash, so before Trump announced his tariffs back then. So from a speculative angle, and also from a regulatory angle, it's very much of a gray area, if not a red area, as to how people are operating currently, or how the administration or the administration is operating currently.
Yeah, so it will be interesting to just kind of see what happens with everything there. I know we're all hoping for clarity to or market structure, if it's clarity, or some other bill to pass into law, so that the rules of the game can't change from administration to administration, and we'll just have to see what happens there. And related to your kind of like buy the rumor, sell the news point of view, it is kind of fast. Usually when I see news that people sell off of or buy into, it's almost like a surprise, like when BlackRock filed for its Bitcoin ETF. But like you said, a lot of other things like the actual trading of the ETFs, like just to pick one example, those have been priced in because they're well telegraphed. And I know that this interpretive guidance was also coming. So who knows? All right. Well, we actually have to leave it there. But before I go, Laurens, I just want to give you a chance to provide any final thoughts, anything that we didn't get a chance to discuss before we move on.
I had something, but I just lost it. Yeah, I lost it. I was thinking about the fact how I'm very excited about how we're moving forward from a regulatory perspective and how that's all super positive for the industry, which makes me very optimistic, right? If we just wait for the market to slowly recover here, I think it's going to be a very exciting few years into the future, right? Not intraday or in the next 2-3 months, but all this clarity being built by US regulators, by regulators across the world. We're also seeing regulators in Korea and Japan trying to fully embrace Bitcoin and crypto as a whole, trying to integrate it into their financial system. So that's all very positive developments, and yeah, I'm excited for the future, and I hope we can contribute with Kaiko to build that financial infrastructure, which is something we're very busy with right now. And yeah, I'll like to leave it at that.
Okay, great.
Stephen.
All right, yeah, well, yeah. Thank you for coming on Bits and Bips,